Hey, good morning, and thank you for joining the Saskatchewan Retirees Association webcast. My name is Harold Hugg, President of SRA. And on behalf of the SRA Board of Directors, we're very happy to see the interest of members of today's topic, smart planning for stronger future, guided by Plannera, powered by PEPP. I see we have 130 folks that actually registered for today's webinar. That's great, and we hope you enjoy it. I want to first take a moment to acknowledge the land on which we gather is Treaty 4 territory, the traditional lands of the Cree, the Dakota, Nakota, Lakota, the Saltex, and the homeland of the Métis Nation. As you know, last year, we celebrated our 50th year as an organization. And what a year it was. We introduced our Legacy Scholarship Program benefiting SRA family members. We introduced a new service supported by Trip Merchant, offering members the opportunity to enjoy discounts on travel. We completed our new 3-year strategic plan to better serve our members. We sponsored membership luncheons in Saskatoon and Regina, and we awarded 15 member $50 gift certificates just in time for Christmas. This year will be another exciting year for SRA. We are starting this year and hearing from you, our members, with the launch of our membership survey managed by Insightrix. You were likely contacted in February, and we hope you have participated. The survey will ensure that we continue to meet members' needs and expectations. We will be sharing the results of our member survey with a presentation of our findings at the AGM on May 21st in Regina. And we'll also be sending out information to members as well. The board has also agreed to move forward on several important initiatives, including a more modest legacy scholarship program for 2026, a review of our accumulated surplus, and a review of how we manage our database and operational workload. As president of SRA, I recently held an informal meeting with the members of the British Columbia Government Retired Employees Association. This meeting focused on discussing the similarities and the differences of our organizations. But there was also interest expressed in working with other government retiree organizations across Canada to identify collective opportunities, particularly as retiree population grows, and how we could use this as a powerful lobby in the interest of retirees. The bottom line of all this is to better serve you, our members. Our mandate, of course, is to provide services and support to meet the needs of retiring provincial public sector employees. Now with over 4,000 members, we continue to strive towards fulfilling our mandate. One of our major focuses is continue to attract new retirees and grow and strengthen the association. Our webcast today is a continuation of a series of informative sessions that SRA has initiated that reflects our commitment to engage and inform members on topics of interest. At the end of this session, you will be asked for your thoughts and ideas on topics of interest for future webinars. Please take a moment to share your ideas with us. Again, we are pleased to be able to bring this webcast to you today to inform and respond to your questions. Now I want to provide a little bit of information on the webinar itself. At any time, you can ask questions or make a comment by using the Ask Questions box in the right of your screen. We will be identifying members asking the questions by their first name, and this will enable us to follow up if there is a need for more detail. Similar questions may be grouped together, so we can get as many questions to our guest as possible during the time we have this morning. And following the session, this webcast will be uploaded to YouTube and available on our website for future viewing. So if people miss it today, they'll be able to look at it in the future on the website. I now want to introduce John Mowbray, who will be assisting this process today with handling questions and helping us move through the agenda. John will also be introducing speakers later on. Welcome, John. If you have any technical difficulties during the webcast, please click the tech support button on the top right of your screen, and VoiceWorks will help and try resolve any issues that you might be having. I would now like to turn this over to John Mowbray, Chair of Pensions and Issues Committee, who will be introducing our guest speakers. Thanks, John. Take it away.
Thank you, Harold. Members of our committee meet quarterly with people from Plannera to talk about areas of mutual interest. Keeping our members informed about their pensions is one of those areas. So we were pleased when Plannera agreed to do a webinar with us on PEPP and the services and tools that are available to help PEPP members with their retirement planning. We're really happy to have 3 people from Plannera with us today. Ethan Anderson will be the presenter this morning. Ethan's a retirement information consultant at Plannera. He has a degree in finance with distinction, and he's earned his qualified associate financial planner designation. Ethan's been with Plannera since 2022. His goal is to provide members with the tools, resources, and knowledge they need to make well-informed financial decisions. Nick Saparaya and Rejoice Oduagara are here to respond to questions following the presentation. Nick joined Plannera in 2024 as a retirement information consultant. Nick was promoted to manager, personal finance, and employer relations in 2025. In this role, he mentors and develops the retirement information consultant team, helping to ensure a high standard of service and member support. Nick holds certified financial planner and personal financial planner designations. His financial experience includes roles as a financial advisor, financial planner, and a manager within the private sector. Rejoice has worked at Plannera as a retirement information consultant since 2024. She provides retirement advice through one-on-one consultations and educational sessions. Rejoice holds a degree in economics from the University of Saskatchewan, chartered financial planner and registered financial and retirement advisor designations, as well as other professional certifications. Her mission is to help individuals establish clear roadmaps for a secure and fulfilling future. So with that, I'm going to turn things over to Ethan Anderson for the presentation. Please welcome Ethan.
All right, good morning, everybody, and welcome. Again, my name is Ethan Anderson. I will be leading today's session. Before we do begin, I want to share a sincere thanks to the Saskatchewan Retirees Association for inviting us to present to your organization today. We do appreciate the opportunity to spend this time with you this morning. And thanks as well to all of you for joining us. Again, our goal today is to provide clear and practical information so that you can feel more confident about your PEPP pension and the choices that come with it. So kind of a breakdown of what we're going to cover today. We will start with a quick introduction to Plannera and the Retirement Information Consultant team. Then we will walk through PEPP's retirement income options and what those can look like when you're ready to turn your savings into income. And then after that, we will review your PEPP investment options and how to think about them based on your timeline and your comfort level. And then we will finish by debunking a few common myths about the plan so that you guys can leave with just the facts. And then as mentioned before, a quick note on the questions, please use the chat box at any time to send the questions as they come up, and we'll answer those questions at the end of the presentation. So with that, let's dive into things. So this slide gives a quick sense of the scale behind Plannera and why that matters to members. Plannera partners with employers and members to support a secure financial future. And right now we administer about $17 billion in assets, and we serve roughly 112,000 plan members and annuitants. So across all of our work, we administer 27 different plans, and we have about 155 different employees. So I share those numbers for one reason. I think that they highlight that you are part of a large established organization with dedicated teams and strong systems in place to support your pension and your benefits. And at the same time, this work is personal. Our commitment runs deep because the people we serve are not just members, they are our friends, our family, neighbors, and coworkers across Saskatchewan and beyond. So again, Plannera is the organization that administers PEPP, along with a number of other pension plans and benefit plans across Saskatchewan. So in total, Plannera administers 11 pension plans and 16 benefit plans. On the pension side, two of the largest plans that we administer are the Public Employees Pension Plan, or PEPP, and the Municipal Employees Pension Plan, or MEP. So what that looks like on a day-to-day basis is a mix of kind of plan administration, employer support, and member support. So on the member side, we help in a few practical ways. We do support financial and retirement planning conversations. We offer workshops like this one, and we also provide one-on-one member consultations for those who want help understanding their options and what next steps can look like. We also work with more than 900 different employers across Saskatchewan. So that could include, the provincial employees, crown corporations, municipalities, and school divisions. So overall, our role is to make sure that the plan is administered properly and that members have support and information when they need it. And then on the next slide here, I will talk more specifically to our Retirement Information Consultant team, or RIC team, and how we work directly with members. So again, our team here, we are the Retirement Information Consultant Team, or the RIC team. There are 6 of us, and our role is to support members at every stage, whether you're still working and planning ahead, maybe getting close to retirement and making decisions, or already retired and focusing on staying on track. We do come from a mix of backgrounds and designations, as previously mentioned, but we all share the same goal. We help you understand your pension, your options, and the steps you can take to feel more confident about your retirement income. And I'd say there's kind of 3 main ways that we support members. The first is with retirement planning support. So this is where we help you connect the dots between your pension, your savings, and your goals. So that might look like talking through your expected retirement timeline, what your retirement income could look like, and how different choices can impact your income over time. We can also help you understand the options available through PEPP when it's time to start income and what each option is designated to do for you. The second kind of topic here is our planning tool. So this is a very practical resource you can use to build a clear picture of retirement. It helps you explore different scenarios, compare possibilities, and get a sense of how your choices today can affect your future income. And some people like to use it as a starting point, then meet with us afterwards to talk through what they're seeing and what it means for them. And then third, and I'd say most importantly, is individual consultations. So this is where we sit down with you one-on-one and focus on your personal situation. So this can be done virtually, by phone, or by in person. And so people use these meetings for all kinds of reasons. Sometimes it's a simple question about what these options mean. Other times it's walking through a bigger decision in life as to when to start government benefits, when to start planning for retirement, am I on track, etc. So I guess the main point here is wherever you're at, you don't have to figure it out alone. We are here to make your information more clear, help you understand your options, and support you in making decisions that fit your lifestyle. All right, so now we're going to shift into kind of the first big topic for today, which is PEPP's retirement income options. So this slide is the high-level view, but when you're ready to start retirement income from PEPP, you can be used, or essentially you have 2 different options. The option number 1 is something called the variable pension benefit, and you can think of this as income that is paid from your own account balance. So your payments are designed to be stable, but your account balance can move up or down over time, depending on the investment option that you choose, and we'll touch on investments later on today. The other option is a lifetime pension, and this is a pension you receive for as long as you live. So it is designed to provide long-term stability and predictability because it continues no matter how long you live. Whether you're age 80 or 150, you're still going to get a payment from the lifetime pension. And oftentimes, it's not always an either-or choice. These 2 options can be combined, which can give you a mix of flexibility and stability. For example, some people like having a lifetime pension as a steady foundation and then using the variable pension benefit, or the VPB, alongside for extra flexibility to draw income when needed. So before you can start either option, there are 2 basic eligibility requirements. So the first one is you have to be at least age 50. And the second one is you can no longer be employed by a PEPP employer. So 2 criteria: to be at least age 50 and no longer working for a PEPP employer. So once those 2 requirements are met, you can choose the option or combination that best matches your needs and your plans. So over the next few slides here, we're going to break down each option in more detail, talk about the main features of each of them, and highlight what to consider so you can start thinking about what might fit you best. All right, so the first retirement income option we're going to talk about is the lifetime pension. And this is a newer retirement income option available to PEPP members. And the main idea is relatively simple. It provides dependable monthly retirement income for life. Again, whether you're live till age 80 or 140, you're still going to get paid from the lifetime pension. You can think of it as taking a portion of your PEPP account and turning it into a dependable paycheck that continues for as long as you live. So the reason this option matters is because one of the biggest questions in retirement is not just how much you have saved, but whether your income will last as long as you do. So the lifetime pension is designed to help address that longevity risk. It is a way to build more certainty into your retirement income plan. It is also designed to work well alongside with the variable pension benefits, so you do not have to only choose one. Many members use a combination because they serve different purposes. The variable pension benefit can offer more flexibility and access to funds, especially earlier in retirement, while the lifetime pension can act as a steady foundation that is there every month for the long term. So another way to look at it is how retirement spending often changes over time. So many people spend more money in their early years when they're still active, when they're traveling, when they're doing more, and spending can level off later off in life. So the lifetime pension is built with that kind of long-term stability in mind, so that even as life changes, you still have reliable income streams in place. And then finally here, it can help complement other sources of retirement income, like your Canada pension plan or your old age security plan. When you put those together, it can create a more balanced and dependable retirement income picture for you. So kind of the takeaway for this one is the lifetime pension is about stability and peace of mind. It is dependable monthly retirement income for life, and it can be used on its own, or it can be combined with the VPB to benefit both sides of the picture there. Okay, so now that we've kind of introduced the lifetime pension, let's walk through some of the kind of key features so that you understand how it works and what it's designed to do for you. So again, it is dependable lifetime income. Once you purchase it, payments continue as long as you live. And that is kind of the core benefit. And it is also how it helps mitigate longevity risk, which is the risk of living longer than expected and worrying about whether your income will last. It is designed to be kind of a long-term inflation hedge. So payments are not guaranteed to increase every year, but they can adjust over time, which helps your income better keep up with inflation over the long term. And then next here are the options that help you tailor the lifetime pension to your situation. So you can choose something called a guarantee period of either 5, 10, or 15 years. And this means that if you pass away earlier than expected, payments will continue for the remainder of that guarantee period to your beneficiary or your estate. So if you have a spouse, you can also choose something called a joint survivor option of either 60% or 100%. So this means that after your death, a portion or all of your pension income can continue to your spouse for the rest of their life. So now those two features can work together. So I'm going to try and break it down into two different examples here. So let's say that you choose a 10-year guarantee period and a 60% survivor benefit option. So if you pass away in year 6, there's still 4 years left in that 10-year guarantee period. So during those remaining 4 years, the payments would continue at the same level because the guarantee period is still in place. After that guarantee period ends, your spouse would then continue to receive 60% of that payment amount for the rest of their life. So if you had chosen 100% survivor benefit instead, your spouse would continue to receive the full payment amount after the guarantee period has ended. So alternatively, if you are single, you only have the option of the guarantee periods of either 5, 10, or 15 years. So for example, if you choose a 10-year guarantee period and you pass away after 5 years, your beneficiary or your estate would receive payments for another 5 years to complete that 10-year guarantee period. And then after that 10-year period is over, no further payments would be made. So remember that as long as the member is alive, they would be receiving payments. So if they live till age 80 or 100, they'll still receive payments, but that guarantee period is only in place for if something happens prematurely. So again, the guarantee period is focused on providing protection in the early years, while the survivor option is focused on providing ongoing income for a spouse for the long term. So kind of together, they can create both short-term and long-term security for your family. So now let's talk about how payment adjustments work, because this is an important piece of this plan. So your payments are not fixed forever. So each year, payments are reviewed and may be adjusted up or down based on the hurdle rate and the performance of PEPP's moderate fund. So the hurdle rate is basically a benchmark return. So for the lifetime pension, the hurdle rate is set at 4%. So it is used to calculate your initial payment, and it becomes the reference point for future annual adjustments. So for example, if the moderate fund earns more than the hurdle rate, your payments may increase. And if the returns are below that 4% hurdle rate, your payments may decrease. So the purpose of these adjustments is to keep the lifetime pension sustainable over the long term and aligned with actual investment performance. So for example here, let's say the moderate fund returns 6% and the hurdle rate is 4%. So you would see a 2% increase in your payments the following year. And on the flip side of that, let's say that if the moderate fund performs 2% and the hurdle rate's 4%, you would see a 2% decrease in your payments the following year. So kind of to wrap up this slide here, the lifetime pension is designed to provide dependable monthly retirement income for life, reduce longevity risk, and offers a built-in way for income to adjust over time, and gives you flexibility through guarantee period and survivor benefit options, depending on what matters most for your situation. So this slide kind of highlights some of the early results from the first year of the lifetime pension rollout. So the lifetime pension is the first of its kind in this space because it is designed to provide dependable income for life while still fitting within PEP structure. So in year number one, members invested about $7.4 million into the lifetime pension across 28 different members. The design and innovation behind it was also recognized through a World Pension Award nomination. And on the education side, there's been strong interest with 850 attendees joining through 8 different webinars. So the point of sharing this is to show that this option is already being used by members, and it has been receiving attention for the way it's been supporting members for dependable lifetime income. And then now that you have kind of a sense of what the lifetime pension is and what the features are, I do want to show you a tool that can help you visualize it. So on the PEPP website, under the retirement income section, there is a lifetime pension calculator. So this is a simple way to model out different choices and get an estimate of what your first year of retirement lifetime pension payments may look like. So you can enter in a few basic details like your age and your PEPP account balance. If you do have a spouse and are considering a joint survivor option, you can include your spouse's age as well. And then from there, essentially, the calculator lets you test different scenarios. So for example, you can adjust how much of your PEPP pension or PEPP account you want to allocate to the lifetime pension versus keeping in the variable pension benefit or VPB. And essentially, some people like to put a portion into the lifetime pension to create a dependable monthly base of income while keeping the rest in the VPB for flexibility and access to funds. So, as you change the inputs, the calculator updates the results so that you can see how those decisions impact your estimated monthly income. And it is helpful to compare options side by side to get a better feel for the trade-offs between, stability and flexibility. And the key thing to remember here is that the calculator provides rough estimates. So it is meant to help you explore the plan and not necessarily replace an exact quote. So if you want a firm number based on your specific account balance and choices, that is something PEPP can provide when you're closer to starting that income. But as a planning tool, it is a great way to start building a clearer picture of what different retirement income combinations could look like for you. All right, so now that we've covered the lifetime pension, let's talk about the second retirement income option, the variable pension benefit, or the VPB. So if you are familiar with the RIF, a registered retirement income fund, the VPB works in a very similar way. So it is essentially an unlocked pot of money from your PEPP account that you move into retirement income. So from there, you decide how and when to take that money out of your PEPP account or VPB account. So the VPB lets you transfer part or all of your PEPP account into a retirement income arrangement where the funds remain invested. So once your money is in the VPB, you're no longer contributing to PEPP, usually because you've retired or you've left your PEPP employment. And then kind of flexibility and withdrawals. So the main feature of a VPB is flexibility and control. So you can choose the amount you withdraw and you can change it at any point. So you can take income monthly or annually, and you can also take something called lump sum withdrawals when needed throughout the year. So kind of a key rule to know, and it's similar with the RIFs, is that before age 72, there's no minimum withdrawal requirement. So starting at age 72, the CRA requires a minimum annual withdrawal based on your account balance, similar to RIF rules. So before you turn 72, you can take as little or as much as you want from your VPB account. But from age 72 onwards, there is a minimum amount that you must take from your VPB account each year. So there's also no maximum withdrawals, which means that you can take more in a year where you need it and less in years where you don't. So that's kind of the flexibility side of things. And I'll give you a couple examples here. So let's say Caitlin retires at 63 and moves her PEPP balance into the VPB. So she starts with a modest monthly payment to cover her regular expenses. And then a couple years later, she needs to replace her vehicle. So she takes a one-time lump sum payment. And then after that, she lowers her monthly payments again so that the remaining balance can work for her. Another example here would be, let's say Dave retires at age 61 and delays his Canada pension plan. He uses VPB withdrawals to cover part of his income for a few years. And then once his CPP and his OAS begin, he reduces his VPB withdrawals so that the account can last longer. Investments inside the variable pension benefit. So your money does not stop working for you once you go into the variable pension benefit. The balance remains invested, and you can continue to make investment decisions based on your risk tolerance and comfort level. So your investment options generally stay the same unless you request a change. For example, let's take Sharon, for example. Sharon is comfortable managing investments and likes having control. So she chooses the VPB so that she can stay invested and adjust her investment mix over time and as her needs and comfort level changes. And then spouse and beneficiary rules here. So this is an important consideration. So by default, your spouse is your designated beneficiary. So if you don't have a spouse, you can name anyone you want as your beneficiary. And then if you do pass away, any remaining balance in the VPB is paid out to your beneficiary or your spouse, depending on what is on file. So if you do pass away with money left in your account, it doesn't disappear. It does go to somebody. And then kind of a little tax tip here. Pension income splitting. So another feature that can be helpful for some couples is that VPB income qualifies as eligible pension income as of age 65. So that means that you may be able to split up to 50% of that income with your spouse for tax purposes when you file your tax returns. So for example here, let's say Paul starts the VPB payments at age 66, and then at tax time, he and his spouse split part of that pension income, which can help reduce their overall tax bill depending on their income levels. So kind of overall, or the key takeaway for the VPB here is that the VPB offers kind of maximum flexibility and control over your retirement income. It works well for members who want, that adaptability and access to funds, but it also requires planning and discipline so that the income lasts throughout retirement. So those are kind of the two main options. And now I kind of want to dive into or discuss your investments with PEPP, kind of by starting with the three different asset classes that PEPP invests in. So again, there are three asset classes that PEPP invests in to grow your pot of money. So the three are equities, alternatives, and fixed income. So I do get a common question when the markets kind of go wonky. For instance, Ethan, the TSX or the Toronto Stock Exchange went up 5%. Why didn't my pension go up 5%? Or the S&P went up 3%. Why doesn't my PEPP account reflect that? So in this scenario here, these members are investing solely in stocks and may not have exposure to a balanced portfolio that includes, fixed income or alternative investments. So as a pension, we invest in more than just stocks, such as, fixed income and alternatives that have different risk and return profiles. So that's why our returns will vary from any one stock indice or investment fund. And then, I'm going to try and break down each of these asset classes in a little more detail here. So starting with what are equities or what are stocks? So equities represent ownership in a company. So when you buy a stock, you essentially own a piece of that business. And so returns come from two different sources, capital gains or growth, which is share price increasing, or dividends, which are companies' profits being shared with investors. There are a variety of different investment styles. There's growth investing, which focuses on companies expected to expand quickly, often reinvesting profits. You may have value investing, which targets companies that may be undervalued by market, offering potential upside, and income investing, focuses on dividend-paying stocks for steady cash flow. So investment styles do mix for balance. Company size, so PEPP invests in both large companies and smaller companies. And geographic regions. So, stocks can be local, such as Canadian stocks. They can be international, like US or Europe, or they can be emerging markets, say like Asia, Latin America, etc. So we are globally diversified. And geographic diversification does help reduce risk and capture global opportunities. And then you may see that we have both public and private stocks or companies that we invest in. But the kind of key takeaway there is that equities can be a powerful growth engine in your portfolio, but it also does come with risk. Diversifying by your style, your size, your region, and type of companies do help manage that risk. And then the next kind of asset class here is alternative investments. So these are long-term investments that a pension can invest in, but retail investors like you or I typically can't. Alternative investments are a financial asset that does not fall into, one of the conventional investment categories like, stocks or bonds or cash. It is for the long-term results, and we do a lot of research before we start investing in these funds. And for example, here, it is used for another layer of diversification. So example, in 2022, when stocks and bonds both went down, the alternative investments actually went up, about 7 to 8%. So it did help with diversification. And, these alternatives can include investments in things like real estate, toll bridges, private equity, private credit, maybe commercial real estate, hospitals, farmland, and many more. But at a glance, it is just a different type of investment. And then lastly here, income or fixed income. It's essentially made up of fixed income contracts to generate income for your fund. So we have some Canadian bonds, we have some foreign bonds and money market funds. So this fund, we are basically trading in the bond market, and it can be volatile, but not as volatile typically as the equity markets. And so now that we've kind of covered the retirement income options and investment side of things, let's shift into more of the investment side and talk about what your investment options are with PEPP. So the first thing to know is that you do have a variety of options, but they are designed to keep things simple and kind of structured for you. So PEPP does offer 6 asset allocation funds, and these ones are shown here on the left-hand side of the slide. So we have the Accelerated Growth Fund, the Growth Fund, Balanced, Moderate, Conservative, and the PEPP Step. So these funds are built using the same kind of main building blocks, equities, income, and alternatives, but the difference is the proportion allocated to each. So that is kind of what creates different levels of expected growth and different levels of risk. So in general, more equities or more stocks means more potential for growth, but also more volatility or more ups and downs in the short term. So more income generally means more stability, but typically lower growth potential. So kind of a key rule here is that you can choose one of the asset allocation funds. So since they already include a mix of equities, income, and alternatives, you cannot stack multiple asset allocation funds on top of one another. So essentially, I can choose to be in the growth fund, and I can't say I want to be in the Accelerated Growth Fund and the Conservative Fund at the same time. I can only choose one or the other because they're all invested in the same assets, just different risk and return profiles. So again, you can choose one of those 6, and then in addition to that, you can also choose the bond fund and or the money market fund that you see at the bottom. So you can select one or both of these. So altogether, you can hold up to 3 different funds at one time. One asset allocation fund, plus either the bond and or money market fund. So for example, I could say I want to be 50% in the growth fund, and then 25% in the bond fund, and 25% in the money market fund, for a total of 3. And then essentially, I want to also spend a little bit of time on the PEPP Step fund shown on the right-hand side of the screen, because it does work a little bit differently. So the PEPP Steps is a life cycle kind of investment made up of 13 different steps. And so you enter that step that matches your age. And then as you get older, you automatically move through the steps without needing to request changes yourself. So as you progress through the steps, the fund gradually becomes more conservative, generally shifting from more income and less equities. So just for an example here, if you are age 40, for example, you would be in step 2, because you see on the far right there's an age band and then the steps as well. So at age 40, you'd be in step 2. And then when you reach age 43, you would automatically move into step 3, and so on and so forth. So every few years, you would gradually move down that risk return chart there. So I'd say that this can be a good option or fit for members who prefer a hands-off approach, where the investment risk kind of adjusts automatically rather than just having to make changes themselves. And then members can transfer in or out of the PEPP Steps at any time using their online account or investment change form. So kind of to recap here, each member can choose one of the 6 asset allocation funds and can add both one of the bond or money market fund, also known as specialty funds, for a total of 3 different funds. So again, the goal is to let you match your investments with your comfort level and the timeline while keeping the choices kind of manageable for you. And then now I kind of want to show you the PEPP funds on a spectrum, because this visual kind of helps members connect everything we kind of just talked about. So on this chart, the bottom axis is risk, moving from lower risk on the left to the higher risk on the right. And the side axis is return, so moving upward. In general, as you take on more risk, you typically have higher return potential, but you also take on more ups and downs or volatility along the way. So, when you look at the standalone funds, you can see how they line up on that spectrum. At the lowest end there, you have the money market fund, which is generally the most conservative option, with the lowest risk and lower return potential. Next is the bond fund, and then the conservative fund. And I want to point out an important note here because it does surprise some people. So the bond fund can usually be a little more volatile than the conservative fund, and that is because it's less diversified. So the conservative fund includes a small allocation to equities and alternative investments, which adds that further layer of diversification and can help stabilize returns over time. And then as you move up the risk spectrum there, you see that the moderate fund, then balanced growth, and then accelerated growth, which is the highest risk and highest return potential of the standalone funds. And then now the other piece of this slide is how the PEPP step funds kind of fit into this picture. So the steps are shown along the same line because each step is essentially a specific risk and return level that lines up with these standalone funds. So if you look on the chart here, at the higher end, step number 1 is the highest risk and is very similar to the accelerated growth fund. And on the other side of that spectrum, step 13 is a low risk step and is very similar to our conservative fund. So again, this kind of spectrum helps you see that PEPP steps is not a completely separate idea. It is essentially a guided path along the same, risk and return scale. So, this is kind of where people find the main benefit of the PEPP steps is it slowly, gradually reduces your risk as you get older or as you near retirement. So again, if you are invested in a standalone fund, let's say the moderate fund, you might have to, and you want to move to say the conservative fund, you'd have to make that decision to change your investment options. But if you're in the PEPP step program, every few years, PEPP handles that for you and moves you along that risk return graph. And then now I kind of want to share a simple strategy that can be used, especially helpful for retirees or anyone close to retirement. And it is called the money market strategy. So kind of the idea here is to reduce the chances that you are going to be forced to sell at a bad time or sell your investments at a bad time, likely during a downturn, just to cover your day-to-day expenses. So you do that by segmenting your money into different buckets based on when you expect to need it. So for instance, here, the first bucket is your short-term money, usually the next 1 to 2 years. So this portion is held in cash-like investments, such as the money market fund. And the purpose here is stability and access. So this money is the money you rely on for immediate living expenses so that it is available when you need it. And it also helps you avoid pulling from longer-term investments when the markets are down. And then the second bucket here is your mid to long-term money. So usually 3 years and beyond. And this portion stays invested in one of PEPP's asset allocation funds, depending on your comfort level. So the goal for this bucket is the longer-term growth so that it can keep up with inflation and continue to support your future cash flow needs. And then if you look at the chart on the right, it kind of shows a basic concept. So a larger portion stays invested in the long term or for the long term, and a smaller portion is allocated in the money market fund for near-term expenses. So here's kind of a quick example of how that can work in practice. So if someone retired and wants to spend, say, $30,000 a year from their PEPP savings, they might keep 1 to 2 years of that amount in the money market fund. So $30,000 to $60,000 in the money market fund. Then if the markets do go down, they can draw their income from the money market fund bucket instead of selling the long-term investments at a potential loss. And then when markets recover, they can kind of refill that short-term bucket from their longer-term portion. So again, the main benefits are that it helps retirees avoid selling a potential loss in market downturns. Because again, we don't know markets from day to day. There's a lot of volatility. It does provide liquidity for near-term expenses, and it gives the longer-term investments time to recover and to grow. And please know that this strategy isn't necessary for all PEPP members. And I do recommend that you reach out to us if you have any questions or want to consider the strategy for your retirement plan. And then I do want to spend a minute on fees because fees can feel small at the moment or during the moment, but over the time, they can make a big difference in the way of how you invest and what you keep in your pocket. So typically when banks, investment firms or pensions talk about the cost of managing investments, they often use a term called management expense ratio, MER, or expense ratio. And the easiest way to think about this is this. So it is the percentage that is carved out of your investment returns to cover the cost of running and managing the fund. So on the slide here, it kind of shows a simple example using a gross rate of return of 7.5%. So on the left-hand side here, we have a PEPP example. If the gross rate of return is 7.5% and the expense ratio is 1.04%, that 1.04% is the portion that is carved out to cover expenses. So what you are left with is a net return of 6.46% that stays in your account and continues to compound and grow for you. And then on the right-hand side here, that same bar, you'll see that we show a more typical retail financial institution example. Retail fees can be around between 2 and 2.5% or more, depending on what you're investing in. In this example, the net return after fees is 5.35%. So, at a first glance, the difference between 6.46 and 5.35 doesn't look huge. It's roughly 1%. But the key difference here is that this happens every year and it does compound over time. So this is what the chart on the right is showing. So with an initial $10,000 deposit, the PEPP net return and the financial institution net return start out fairly close, but over time that gap does grow. So after 10 years, the difference is a little noticeable. After 20 years, it gets larger. After 30, it becomes significant. And then after 40, there is a big gap. So, using the value shown on the left side, on the right side here, after 40 years, the PEPP account grows to roughly 122,000, while on the financial institution side, it grows to about 80,000. So that is a $40,000 difference from fees alone on a $10,000 deposit. And if you do scale that up, the impact becomes even bigger. So instead of $10,000, maybe you invest $100,000 over that same time frame. It could make a big difference of up to $400,000. So again, that means you could possibly retire earlier. Maybe you could spend more in retirement, do other things, support family. So there's a lot of different choices that become available. And then another important piece to mention is that PEPP and Plannera are not for profit. So no one in our office receives commission or bonuses based on what you do. And when we meet with members, our goal is education and support, and we can provide guidance with unbiased perspective. So the key takeaway here is the lower fees may not feel dramatic in a single year, but over the long term, they can have a major impact on the growth of your account and the income that you can generate in retirement. And then I kind of want to highlight another option some members are not aware of, which is consolidating other retirement savings into PEPP through a transfer. So in certain situations, you may be able to transfer eligible funds from an RSP, maybe a registered pension plan, or a LIRA, a locked-in retirement account, into your PEPP account. So the benefit is simplicity. Bringing accounts together can make retirement planning easier to manage. PEPP also uses professional investment managers and has one low administrative fee that covers investment management, custody, and administration. So who can transfer? So I would say that all PEPP members can transfer eligible funds at any time, as long as the money meets the plan's transfer rules. So at this time, only Saskatchewan registered funds can be accepted. So eligibility does depend on where the funds are held and how they are regulated. So kind of how does it work in the background? I would say first step is to contact PEPP. They'll review your situation, confirm your eligibility, and explain the transfer process before anything moves. And then what about fees or cost? So PEPP does not charge a fee to receive funds, but your financial institution may charge fees to transfer money out. So some investments like, say, mutual funds or GICs, which are guaranteed investment certificates, may also have lock-in periods or early withdrawal penalties. So there can be fees from transferring out. And you just want to make sure that you understand what those fees are before you action your account. So it is important to ask about fees up front. And then just to connect this back to retirement income, once you have a VPB account open, you do have access to the funds right away for retirement income, or you can leave them invested and grow until you're ready to withdraw. And even if you are in the VPB, you can still consolidate and transfer money into your account. So as we head into a few wrap-up slides here, I do want to discuss and shed some light on the most common misconceptions about PEPP and kind of provide you with the facts. So you don't need to transfer, I guess number one, you don't need to transfer funds out when you retire. So when it is time to retire, you do have retirement income options through PEPP. So you can draw income through the variable pension benefit or the VPB, or choose a lifetime pension. And your decision depends on your lifestyle needs and how much flexibility or guaranteed income you want. So if you're wanting if you want more information on these topics, I'd recommend you check out our website or book a meeting with us. Number two there, you can stay with PEPP after age 71. So at age 71, you don't have to transfer out of PEPP. Like I mentioned, you do have retirement income options with PEPP, the VPB and the lifetime pension. But by the age of 71, you must make a decision on which option you're going to choose if you haven't done so already. Number three, your money still grows in the VPB. So when you retire, you're no longer making contributions to your PEPP account, but your account is still invested and intended to grow throughout your retirement to provide you with retirement income. So kind of understanding your comfort with risks helps you choose the PEPP investment option that kind of fits your personality, your goals, and your timeline. So whether you prefer stability or growth, knowing your investor profile keeps you aligned with the right strategy. And we do have an investor profile kind of questionnaire on our PEPP website that will guide you through a series of questions to help you determine the right investment fund for you. It is a guide only, so if you are questioning your investment or have any questions regarding that, you're welcome to reach out to us or book a meeting with us as well. And then PEPP offers personalized services. So we offer a variety of services to PEPP members. We offer employer-sponsored webinars and Plannera-hosted webinars and workshops. So check out our website for upcoming events. And then we have a retirement planning software that kind of helps you map out your retirement plan and to see if you are on track. So you can call or email us at any time to discuss your questions regarding your PEPP account, your investments, your retirement income options. Maybe you have tax or estate considerations. So again, we do offer free one-on-one consultations. You can meet with us as often as you want. And we typically recommend that you meet with us at least once a year. And then the last one here, the VPB isn't as tax efficient as a PRIF or a prescribed registered retirement income fund. So the VPB and the PRIF kind of offer the same features, including tax-deferred growth while you're still working and contributing. And then when you retire, both accounts are designed to provide taxable retirement income to you. And then the main goal of today's session is to encourage you to think beyond the usual retirement questions like, when do I want to retire? Or how long will I live? Those questions do matter, but retirement planning goes much deeper than that. A big part of it is making sure that your money lasts as long as you do, and that requires, estimating timelines that can sometimes feel uncomfortable. But more importantly, retirement planning is not just something you do once and forget it. It is a process, and your plan should be reviewed regularly, at least once a year, because life will continue to change during retirement. Health, family needs, spending habits, and your goals can change. So that's why annual reviews are essential. Whether you meet with your advisor, work with someone from our team, or use the tools on the PEPP website, checking in every year does help you maintain that track record. So again, we do receive many calls from members asking if they're still on pace to retire the way that they hoped, and regular reviews can help answer those questions before any problems arise. And then just to wrap things up here, we do recommend that you register for your online access. So make sure you set up online access to your account. This lets you review your balance. You can track your investments, update your personal information, and stay connected with your plan at all times. Sign up for online correspondence. So by choosing online correspondence, you receive updates faster and can stay informed without waiting for mail. It's also a great and easier way to keep everything organized in one place. And then when you retire, the Enjoy workshop, or we recommend that you attend the Enjoy workshop to help navigate your transition. It does cover income options, lifestyle planning, and the day-to-day decisions that help come with leaving the workforce. So it is a great way to feel confident as you start this next chapter. And so we do offer 4 different types of workshops right now. There's a Learn, which is for new employees or new to their career. We have Build, which is more mid-career. Prepare to retire, which is if you're gearing up for retirement, and then Enjoy. So, if you are already retired or preparing to retire and you know somebody who's still in the workforce, I do encourage you to recommend one of our workshops, as we hope that we can reach out to them as well. And then lastly here, meet with a RIC at least once a year. So again, we're here to help you. And if you ever want to meet with us one-on-one, we can meet with you virtually, over the phone, or in person. And then lastly here, thank you again to the Saskatchewan Retirees Association, or SRA, for the partnership and for inviting us to present today. We do truly appreciate the opportunity to be here with your members. And thank you to everyone who joined and spent time with us. We covered an introduction to Plannera and the Retirement Information Consultant team, your PEPP retirement income options, including the lifetime pension and the VPB. We touched on your PEPP investment options and a few common myths and questions that come up about the plan. So if you have any questions or would like to meet with us to discuss your situation further, please feel free to reach out to us after the webinar. But we will we will open the floor up to questions now. So if you have a question, send it in the chat and we'll work through as many as we can. But thank you again.
All right. Thanks very much, Nathan. That was Ethan. Sorry, thanks very much, Ethan. That was an excellent presentation. I certainly found it very informative, and as a PEP member, I certainly took some very interesting tips away from that. So what I'd like to do now is turn this over to John, and I know we have several questions that have come in, so we'll try to get through as many as we can. And so, John, with that, maybe I'll just turn it over to you to kind of go through the questions that we have. And thanks again, Ethan, for the great presentation.
Just getting organized here. There are quite a few questions here. Yeah. So there are a couple of people that have sort of asked about how the lifetime pension compares to an annuity, or whether it's the same thing or what's different about it. So I guess the question would be sort of what are the advantages and disadvantages of a lifetime pension versus an annuity?
Okay, sure, John. I can jump in for this question. This is Nick. So for a lifetime pension, as Ethan mentioned, it's a pretty much same like annuity. The only difference with the annuity or the Saskatchewan Pension Annuity Fund, SPAF, your payment will remain same for your lifetime. So let's say if I have a 300,000, I'm buying a annuity, and PEP is saying my payment is a $1,000, depend on my age. That 1,000 will remain same no matter what happened to investment market. Against while lifetime pension, it depends like my pension, like my monthly pension is a $1,000 first year, but that year investment performed really well, and like a moderate fund performance was a 6%. So next year my payment will go up. So I'm getting maybe $1,100. Next year, again, we will review the performance. If the lifetime pension or the moderate fund performance is less than 4%, my payment will go down. So the only difference I will say, like if in the retirement, if you don't want to take any risk at all with your pension, SPAF is the good option where your payment is a guaranteed no matter what. Will with lifetime pension, our goal is to payment to cover the inflation over the period of time. Again, it's not guaranteed, but if you are taking an average of like a 5 year, 10 year, our expectation payment will go up. So the lifetime pension, your payment will swing year over year, depend on the investment performance.
What if the moderate fund makes a negative 5%? Then what would happen to the payment? What would the payment be?
Okay, I can again jump in for this question. So our hurdle rate is a 4%, as we mentioned into the presentation. So when we are giving you the payment schedule, we already assume like moderate fund will achieve the 4% year over year. So like in your question, what happened if there is a negative 5% return? So that means 4% didn't come true, or moderate fund didn't achieve the 4%. So we will adjust your payment negative 9%. So let's say if your payment is a $1,000, next year your payment will go $90 down. So it will be $910 for a next year.
Here's another one. Can you move a RIF into PEP, a RIF held in a Saskatchewan bank?
Yeah, sure. Like if you are holding a RIF with a bank or your investor firm, you can definitely move it to your PEP account or your variable pension benefit account. You need to fill out that form called the T2033. You can reach out to the RIC team. We are happy to help you to fill out those form and initiate the transfer process.
My spouse currently works at a non-PEP employer. Is there any consideration that the PEP board will approve non-PEP spouses to move their group RSPs to a separate PEP account?
So at this moment, spouse cannot directly move money to the PEP because spouse is not a PEP member. And I'm not, I cannot say like we are working in that direction. Maybe in the future it will happen. But like, let's say if you are a PEP member and your spouse is a beneficiary, okay? If you pass away, like as a member pass away, your account will roll over under your spouse. Your spouse will become the PEP member upon your death. In that case, if your spouse want to move other investment like RRSP or the REIF or other Saskatchewan pension to PEP, yes, your spouse can do it.
Here's another one about the lifetime pension. I believe. What are the tax implications of payments to the estate if you die before the guaranteed period?
So when you are upon your death and you are still into the guarantee period, and if money is going into the estate, your estate will pay the flat tax on the amount you receive. So let's say, again, the example, you are buying a 10 years guarantee period, and like after 5 years, if you pass away, there is still 5 years left. We will calculate your payment. So for a year, it's a 12,000. For a 5 year, it's a 60,000. We will be paying a 60,000 to your estate, and your estate will pay tax on the total income, like from the other sources too. So again, there is no straightforward answer, like you are paying a 25% or 30%. It depends on the total income of your estate account.
Here's another one. I transferred my RSPs to PEP 10 years ago. At age 71, do I also choose to move that to a lifetime pension or a variable pension benefit, or do I need to withdraw it?
Sorry, John, can you repeat question one time for me? Sorry for that.
Yeah, just a second here. Said I transferred my RRSPs to PEP 10 years ago. At age 71, do I choose to move that to a lifetime pension or a variable pension benefit? Or do I have to withdraw it at age 71?
So age 71, like as per the CRA ITA minimum rule, you cannot stay into the PEP or RRSP account, okay? You need to make the decision. If you are in the RRSP account, you need to move your money to the RIF, like registered income fund. Or if you are in the PEP account at age 71, you need to decide either you can move to the variable pension benefit or the lifetime pension option. 72, you need to start withdrawing a minimum amount, which is set by the CRA. So again, you don't need to withdraw all of the money at the same time. But once you move your money to the variable pension benefit or the lifetime pension, you can start withdrawing a monthly on the yearly basis. Minimum amount. And if you need more than minimum, you can definitely withdraw more than minimum too.
Another one here. Can you continue to contribute to PEP after retirement to increase investments in your portfolio?
Okay, and I'll take that question. So once you're retired, like Ethan already mentioned, no more contributions into it. But if you have RSPs, LIRAs that are legislated in Saskatchewan or previous pensions legislated in Saskatchewan, you can transfer those over to PEP, but no more new contribution. The funds needs to be already in a registered account in order for those funds to come to PEP.
Let's see. Regarding the variable pension benefits, we determine how much tax is taken off. Are there any variable pension benefit plan admin fees? Oh, there's three questions here. Are there any withdrawal redemption fees? So I guess the first one was, do we determine how much tax is taken off?
Yeah,
Okay, I can. Oh, go ahead, Rizais.
Okay, so if you remember when you completed your VPB application, you would usually be required to complete the tax forms, the TD1 tax forms. So based on the instructions that you have on there, PEP is going to tax you accordingly. So if you can repeat the Part B part of the question, because that question has Part B and C.
And the second part of the question was, are there any variable pension benefit plan admin fees?
There is no specific administration fee, so to say, other than just your management expense ratio fee, which is pretty standard if you're invested in the market, and it's the same across board, whether you're with PEP or you're at other financial institution. There's going to be the MER fee charge, and that's pretty much all the fees that PEP charge. But again, depending on what transactions you're doing and how you're doing it, for example, if you're requesting to change your payment or making investment changes while you're in the VPD. If you're sending in the paperwork, there are limits to there's limit to how long you can do it, and then there will be no fee. But once you go above those threshold, and there's going to be fee. But whatever you do online using the online portal, there's no fees whatsoever.
See, can you change options once you decide? For example, if you take variable pension benefit and you want to do a lifetime pension a year later.
Yeah.
Absolutely. Yeah, you can do that. Say, for example, you've been retired for the last 5 years now, and you've been in the variable pension benefit. And then in the sixth year, you're like, oh, okay, I think I like this lifetime pension option. Can I, move it or do a split? Absolutely, you can. There is no restriction on the timeline. But one thing to keep in mind is the age. Nick, you can correct me on that. So members, it's open to member from age 50 to age 90, right? So as
Yes.
long as you're within those age band, you're good.
Yeah, for once you are in the variable pension benefit, think like this way: you are going in the room, your door will always remain open. If you want to come out from the variable pension benefit, you can. But once you are going into the lifetime pension, basically you are signing a contract. And after that, if you want to change your mind, you cannot, because you already gave your money for a month fixed monthly income, right? So variable pension benefit, yes, you can change at any time later. With lifetime pension, once you sign it, there is no change, or there is no flexibility.
Okay, here's two questions from someone. First one, I saw that 1.04% was used as the PEPP MER in the visual. Is that the current PEPP MER that represents the full all-in cost that PEPP withdraws from our investments each year?
No, like 1.04 we used into the slide, that is for the balance fund. It depends which fund you are investing. In the general idea, I can say like the more you are investing into the stock or the equities, the higher the fees. The less you are investing into the stock or equities, lower the fees. So balance fund, we are investing 42.5% into the stock market. Fees is a 1.04. If you are going little bit higher, like aggressive growth fund is investing 67.5% into the stock market. The fees for the aggressive growth fund is a 1.18%. On the other hand, if you are investing totally into the money market, your fees would be around like 0.38, 0.38. And we are
Okay.
calculating a fees each day. Like, so when we are calculating a unit price at the end of the day, fees is already calculated. So if you are checking in your PEP account, just for example, like if you are saying you have a $500,000 today, if you withdraw it, fees is already calculated on the background.
Okay, then the second question relates to a new concept being discussed by a lot of private planners. It's called the RRSP meltdown strategy, where you get advice on how best to draw from all your different retirement assets, PEP, RRSPs, TFSAs, taxable investments, to minimize lifetime tax paid and maximize the post-tax benefits to your estate.
So again, John, like for this one, there is no straightforward answer because every family's need is a different, right? If you want to know particular about your family, you can book a meeting with us. We can go to your plan. Like we can basically we want to know like what is your expense look like, what is your government benefit, what kind of other investment you have like RRSP, TFSA, and then we can make a plan for you. General idea is like before you start withdrawing your government benefit like CPP and OS, you need, and if you're not working, you need to start melting down your registered account. So that includes your PEP account, your RRSP. And once you start receiving your government benefit, you need to reduce your other account like withdrawal from the registered account, so you will be paying a lower taxes. But again, like if you want to know more about particular situation, feel free to reach out to us after webinar or the later on. We will happy to make a plan for you.
Another question from someone else, are the MER fees for the various accounts posted on the website?
Yes, if you go to our website under the investment section, we have a different funds, and if you click on the fund facts, you can see the fees of all the funds. I can say the highest fees for the aggressive growth fund is a 1.18, and the lowest fees is for the money market. It's around 0.38.
Another question, what happens to my money in the lifetime pension if I have a 10-year guarantee period and I die at 10 years plus a day?
Okay, so I'll take that question. So if this member is single, once the guarantee period is over, then there's no payment going to anyone. But if this member is married and has picked, say, 60% survivor benefit or 100%, now because the guarantee period is over, that's it. So the survivor benefit would kick in. And so if his payment was $1,000 and he had gone for 60% survivor benefit, so the spouse would start getting $600 for payment.
Okay. What are the costs slash MER to PEP members for managing the money in the variable pension benefit and the lifetime plan?
So lifetime pension fees is like you are not paying any separate fees for the lifetime pension. Because we are investing your money into the moderate fund under the lifetime pension, the fees will be 1.08 for the moderate fund. So that's the only fees you are paying, 1.08 to managing the moderate fund or the investment.
Let's see. If I have the lifetime pension and I choose the 10-year guarantee period and I am single, the return average is 4%, and that is what I am paid every year. If I die after 10 years plus a day, what happens to, oh, this is a similar question to the other one. What happens to the original amount I invested? Let's say I invested 1 million. What happens to the balance of the money in the account? Does my estate get it, or is it no longer my money?
So you want me to answer, John, or I think we covered the question? I can just give a general, yeah. Maybe I'll cover general idea. Like when you sign the lifetime pension, it's the same. Like let's say if you're buying a Ford truck, right? Like 100,000. I'm not sure what the cost around, but just for example, you have 100,000 on your hand. You decide to buy a Ford F-150 truck. You are going into the capital dealership. You are giving 100,000, and they are giving a key to you, right? So when you're coming out of the parking lot, what you have now? You have a truck or you have a key in your hand, but you don't have money, right? Same way, when you're buying a lifetime pension, you are giving up your money and you're getting a monthly pension on the paper. Okay. So like let's say if you have $1 million and when you are buying a lifetime pension, maybe we are saying like, hello, your pension, monthly pension is a $5,000. So you will keep receiving a $5,000 till the guarantee period. Okay. And after guarantee period, if you die and if you are single, there will be no more payment. But if guarantee period is not for you, if you're living till 100, you will keep receiving your payment as long as you are living. But once you die and if you are single, if you pass already guarantee period, then there will be no more payment.
Okay, here's another question. Can you transfer funds from an unregistered account to be managed by PEP?
No, at this moment, we are only accepting the registered money. Maybe in the future it will happen, but right now we can only accept the registered money. So if you have a RRSP or a LIRA account or the other Saskatchewan pension, if you want to transfer it to PEP, you can. But if you have a non-registered account, like money sitting into the saving account, and if you want to send it to PEP, you cannot. Or the TFSA, at this moment, we cannot accept the tax-free saving account too.
Let's see. With the Plannera financial planner, is there any way to reflect the future sale of a secondary property and the lower expected utilities tax insurance expenses after sale?
Sorry, John, if you can repeat question one more time for me.
Yeah, it says with the Plannera Sun Life Financial Planner. I don't know if it refers to the lifetime financial
Okay. I
tool.
think,
Is there any way
yeah,
to reflect future sale of a property?
yes, you can. Like, I know, like, member is maybe asking about our retirement planner, Sun Life
Mhm.
retirement planner. Yes, we can definitely enter if you're planning to sell something in the future, like down the line of 5 or 10 years. If you want to know how to do it, you can reach out to us. We are happy to help you, like how to enter those detail into your plan.
One says, not sure. Let's see. I don't think Nick is correct about the pension dropping by 9% after a 5% market drop. Most of the change should be 5%. Otherwise, the plan is worse than not having a plan and simply staying with 4% of the remaining balance. Just something to clarify. Do you want me to read that one again?
No, I think I got it. I think the
Okay.
question was like, what happened if the moderate fund return was a negative 5%? If the moderate fund return is a negative 5%, then the payment will be adjusted negative 9%. Ethan or Riza is correct me if I'm saying something wrong, but yes, like because when we projected your monthly payment, we already assumed a moderate fund will achieve the 4%. So let's say the fund return is a negative 5%. That means that 4% didn't achieve, first of all. So we need to adjust your payment 4%. And plus, there is a negative 5% return too. So the performance or the adjustment will go down next year is a negative 9%. Ethan, did I cover properly or should we add more
Um,
detail?
I think you're good. I think the main thing is there, like the hurdle rate's 4%. And so if you got negative 5%, you're going from 4 down to 0 and then 0 to negative 5, which is in total 9, if that makes sense.
This is another question that just came in sort of following that. It seems like the lifetime pension just pays out your interest earned on the investment used to purchase it. And when a person dies, the principal investment is lost. The lifetime pension pays out the interest earned for life or to a guaranteed period, then the original investment is gone. Is this correct?
Again, with the lifetime pension, it depends on your situation. If you are married, your investment is not gone. Like, okay, if you pass away, your spouse will receive the survivor benefit as long as your spouse live. But if you're a single and if you're already outside of guarantee period, like 5, 10, or 15 years, then yes, there will be no more payment. And when we are calculating a payment, we also factor those things like either member are single or married. So the way how the annuity work, anytime you're buying an annuity, they always calculate couple of things. Number one, your age at the time of purchase, your spouse age at the time of purchase, plus what is the survivor benefit you're buying for your spouse and the guarantee period. And depend on that factors, your payment will be adjusted. And one thing like lifetime pension or the annuity, I'm not saying like it's a option for all the members. It again depend on your family situation, right? And if you have $1 million, you don't need to put all the $1 million into the lifetime pension. The general idea of lifetime pension or annuity, you need to match your fixed expenses with the fixed income. So let's say if you have a $3,000 of a fixed expense in the retirement, just for example, and you are getting a 1,500 or a 2,000 from the government like CPP and OS, that means you are $1,000 away from the cover your fixed expenses. So you need to buy only the lifetime pension equivalent of a $1,000. That means your monthly payment or your fixed expense is covered for your life. Whatever the rest, like the traveling or any other non-discretionary expenses, that you can cover it from the variable pension benefit or the other investment accounts.
Who picks which funds or fund managers uh, to invest in?
So who So we have a board, and we have a policy like how we are going to invest the fund, and our board will decide which fund manager we are going to pick. Just for example, like we are getting so many inquiries from the member nowadays, like cryptocurrency, why we are not investing in a cryptocurrency like a bitcoin or other kind of cryptocurrency. The only thing, again, we are a pension administrator, we need to make sure we are investing responsibly. So when people or our member needs money, money is there. So if you want to know like how we are selecting the investment fund managers or the investment, we have a detailed description on our website. You can visit there. It's up for public. If you cannot able to find it, feel free to reach out to us. Again, we will guide you to the right spot.
On the PEP site, where can I find an ongoing balance of what I have withdrawn and ongoing total of tax paid?
Now, I'll take that. I'll take that question. So, in order to see your transaction history, if you're already in the VPD and withdrawing, you could find that information on the online portal. So, if you log into your online portal, you'll be able to find that information. If you need help navigating, you can reach out to us, and we'll sort of help you figure that out.
And there is one more
On your
spot you can.
statement too. It should be on your
Yes,
statement too. Yeah.
yes. So when you are getting your VPB statement, we are issuing a statement once a year in February or March. You can check on your statement too how much money you withdraw, or what was the performance look like during the 1 year. All the detail is there.
This is a question for us that's come in at least 3 times, and it's just whether the this webinar is going to be available afterwards for people to look at, and will that include the question and answer session? You want to answer that, Harold, or I think I could answer that. I think it is. It is going to be on the SRA website. Here's another one. When is the next workshop, Enjoy workshop for retirees?
So next Android workshop is happening on the June 2nd, 8:30 a.m. in the morning. And it's a webinar. So you can register from our website, 8:30 a.m. in the morning, June 2nd.
Well, Plannera's retirement information consultants, can you arrange virtual meetings for people, or do you have to come into the office to do
No,
your?
Yeah, as we mentioned, if you're not in Rajana or if you are not a person like me would like to drive in the snow, you can definitely book a meeting, virtual meeting. We will send you the team invites, and it's the same like in-person meeting. The only thing, we are connecting virtually. We're gonna share our screen so you can see what we are discussing. We can also do the telephone meeting too. If you have a quick question, we can go through like your question on the telephone too. So telephone, in person in Regina, or a virtual meeting through the Teams.
My spouse was a PEP member and passes away, and I moved my investments out of PEP. Do I have an option to become a PEP member again in the future if I'm not happy with my private investment options? Example, did not know I had an option to stay on with PEP at the time of death.
So again, like if you move directly at the time of the death, that means we never had your account. But like let's say if when your spouse moved, your money moved to the variable pension benefit, and after a couple months or the after a few like years, if you move your money from variable pension benefit to your bank or to your investment firm, yes, we have your detail as a member, you can move it back. Again, reach out to us, we will see what we have on the account and we can give you the definite answer on this one.
I am going to be 70 this fall. I'm still working full time. Does this make a difference to benefits?
In terms of the benefit, again, like if you're asking about your variable pension or the PEP account, there is no difference. If you're asking about your CPP, and if, like let's say if you're not collecting your CPP, definitely you will be getting a higher CPP. There are a few things to consider about a tax consequences when people are working longer years, like 70, 72, because now you after 70 you are also collecting a CPP, OS, and at 72 your minimum withdrawal start kicked in. And if your income, we need to make a plan for you. Again, no straightforward answer for this one without knowing the exact situation. So if you want to discuss more, feel free to reach out one of the consultant, and they will guide you or give you the tailored advice or the information regarding your situation.
How can I select investment percentage in alternatives, amongst alternatives?
So like when you are selecting the fund, there are showing like what percentage is investing into the alternative. But if you're asking like, can I choose the percentage? You cannot. Generally, it's already decided by our board, like how much we are investing into the balance fund or the accelerated growth or the step. So depend on your risk tolerance, or if you want more or less, you can select the different investment, but you cannot choose or customize the alternative investment according to your needs.
With money market strategy with variable pension benefit, I assume that you can identify which fund to withdraw funds from if you've allocated to money market and another asset like balanced.
For sure. Like if you, as Ethan mentioned, if you are splitting your investment into the money market or the different investment, you can tell us like where the money is coming out from. First from the money market, and if money market is completely exhausted, then we are touching the second fund. But you can tell us, or you can decide where the money should be coming out from.
Impact of lower fees. The lower fees may be a benefit for investing in PEPP, but should you also identify that if an alternative investment generates a better return than PEPP to such an extent that it covers the higher fees of the alternative, then the alternative could be a better choice? I guess that's more of a statement than a question.
Maybe, John, I wonder if we could maybe wrap it up, but we've gone a fairly long time. We do keep track of the questions, and we can maybe address some of those questions that weren't answered. I think some of them are being
Yeah.
kind of repeated. That maybe what we could do is just we'll deal with the questions that we have. We do have a list of them, and we can respond, and we can work with our folks from Plannera and PEPP after, and do a follow up with any questions we feel weren't answered. All right. Well, I want to thank Ethan and Nick and Rejoice, for their participation here. That was great. There are lots of absolutely great questions asked. I know I had questions spinning around in my head as well, which many of them came forward. So it was very useful and very informative. So again, thank you guys for great presentation, for great response to our questions. I'd like to sort of remind people of our future webinars that are coming up. We have one coming up with the GMS new portal, which will be taking place on June 9th. And as part of the follow-up questionnaire we ask at the end of this webinar, we ask your ideas on webinars as well. So if you have ideas on topics and interests that you'd like us to talk about, we'd certainly appreciate hearing that as well. And I'd also like to remind members to save the AGM date for this year. It's May 21st, 2026 at the Atlas Hotel in Regina. There will be a buffet dinner provided. It should start around 10 o'clock in the morning. People are sort of welcome to attend. But we'll also be doing this with our friends here from VoiceWorks. We'll be doing this online as well. So people that aren't able to come in person will be able to join in the AGM as well. And again, I want to thank the members of the participating team again. Great conversation from the reps. I hope the information shared today will help answer your questions. And we're glad to see more members participate from across Saskatchewan and beyond in these webcasts option for our members. And please stay logged in. Complete the survey at the end of today's webcast to gather your feedback so we can learn more and experience, plan for future events of this type in the future. And again, thanks, Ethan, Nick, and Rejoice from the Plannera team. Special thanks to the SRI board for your support, and John Mowbray for your stepping in today also to help with the questions and your introductions and help in putting the webinar together. and for supporting the webcast. And special thanks to Terry Scott from VoiceWorks, who does the mechanics behind the scene here that makes this thing all work for us. So again, thanks everyone. And as John mentioned, this will be uploaded to our website. It will be recorded on YouTube, and we will put it on our website. Probably take a couple of weeks to get that up there. But anybody that missed it or wanted to follow through, and that includes the presentation and the questions. So all this information will be on the website. So again, thank you again. See you at the AGM in May. And that's bye for now. Thanks again.